Hello folks, welcome to my YouTube mentorship, the TW Inc. mentorship. In the last video I produced on my YouTube channel, that was the last week's first commentary. I talked about starting this mentorship, especially if the video gets to 30 likes. I think the video got to 26 likes, which for me is fair, and I'm more than grateful to those supporting the channel. So let's make it a habit. Let's continue to support the channel, the likes and stuff. I don't want to bore this video, or basically I wouldn't want to bore my video, so in subsequent videos I wouldn't be talking about liking the video or sharing and stuff, so that we can get straight to business, right? So I want to believe that everyone understands the assignment to my dear listeners on my YouTube. So if you're watching, give a thumbs up. If you haven't subscribed, subscribe to my YouTube channel, and let's get straight to business, okay? Alright. So this is barchart.com. Right, this is barchart.com, and if you're not familiar with barchart.com, it's a tool like TradingView, where you view sites, you view charts and stuff. But barchart is a little bit more sophisticated than the TradingView. And into this lesson, we want to talk about defining the HTF from institutional order flow, basically. And I always talk about institutional order flow here and there, and I believe it's the first lesson everyone's supposed to learn, because it serves as a premise for the underlying narrative you're trying to build in the market. Because recently on the last commentary, somebody made a post, like asked a question, a very brilliant question, I must say. And the person talked about what happens whenever markets trade through levels like the previous day's high or low, the previous monthly high or low, the previous weekly high or low. And the person was asking if bias changes when markets trade into all those liquidity pools. Now, when I saw the question, when I read through it, the first thing is understanding that bias, okay, especially if we're talking about the high time frame institutional order flow, because there's a difference between the high time frame institutional order flow and the drawn liquidity. Sometimes they are overlapping, other times they are opposing, okay? And for periods when the drawn liquidity and the high time frame institutional order flow overlaps, these are periods when for example, the dollar index, I mentioned the high time frame institutional order flow back in December when I made secrets short-term trading. I talked about the fact that DXY is bearish and our expectation on the high time frame chart around that bearishness or the bearish delivery. I also talked about USD CAD, USD CHF, pairs that I figured if we talk about them under the narrative of bearish dollar and high HTF from PDRA that they are likely to reach for, we can arrive at something so that when it happens we can be in sync early on the dollar index, okay? But anyways, what I was trying to say is that DXY is bearish on the monthly chart, and we are now seeing bearish candlesticks on the monthly time frame. So for every month the drawn liquidity would be the previous monthly low or maybe a discount array. That's when the drawn liquidity overlaps the high time from institutional order flow. But periods when markets are making retracement, for example, if we look at the same chart, if we're talking about the same chart on the weekly chart, periods when the markets would return probably to an internal range liquidity, like maybe an inverse fair value gap, and all of those levels, we were calling in previous weeks for a retracement into and stuff. That's drawn liquidity. Even though if markets is trading on a monthly time frame into previous monthly low into a discount array, that's also drawn liquidity. But when drawn liquidity overlaps the high time frame institutional order flow, and there's also scenarios when the drawn liquidity disengages from the high time frame institutional order flow, because we must be clear what the high time frame institutional order flow is. I also said when I was answering the question, talking about how drawn liquidity defines specific price points the markets are likely to engage on the near term, and I also was also talking about the fact that the high time frame institutional order flow predefines what happens when markets engages those specific price points. Okay, I didn't say define, I said predefine. It was a very intentional use of word. Predefined meaning when markets engages external range liquidity pools like previous weekly high, previous day's high, previous monthly high, or previous monthly low, or previous weekly low, whatever. Okay, when markets engages those levels and markets begin to make a retracement, institutional order flow predefines that when markets makes a retracement, is providing you a new opportunity to engage for the market to make a continuation. That's the premise of the high time from institutional order flow. Now, how do we define institutional order flow? That's the $1,000,000 question. Because everyone hears of institutional order flow. How do we define it? And that brings us to the COT data. Because I always talk about COT data, even if there are other macro tools or indicators you can use to define, institutional order flow in quotes. And basically, institutional order flow referring to where the money is going. Okay, where's the money going? What is the current position of smart money in the market? You want to understand the actions they are taking, because it's the action that defines the trend. Okay, and one of the data is COT, the commitment of traders. Now, before we go to barchart.com, let's check cftc.gov. Okay, that's the Commodity Future and Trading Commission. Okay, now this body is like it's not like it's a regulatory body in the United States of America, right? And in promotion of fair markets, free and fair markets, because this capitalism, and one of the core beliefs of a capitalist economy is free markets and stuff. So the body publish open positions in the market. Apparently, this data is always from Tuesday. For example, when they publish it on Friday, okay, the data is actually as of Tuesday, but it takes about 3 days before they run all of the data and publish it. So you can see that the data itself, it's not usually up to date. But the truth is, even regardless of it, you can check the market data, economic analysis, commitment of traders. So regardless of that fact, right, the trend in the market obviously doesn't shift. Okay, there can't be any sudden shift, and even if there's a sudden shift, it takes time for it to get priced in. Okay, earlier this year we was talking about bearish dollar. We knew since December, but it only got priced in February because January was a consolidation. But obviously, January's candle closure also just gave off the fact that, you know, February was going to be bearish, and February gave off the fact that March was going to be bearish. So this is the Chicago Mercantile Exchange, and we want to check the short format. Okay, is the short format we're looking at. So in the short format, this is it, and this is, you know, we have the data here. See, live cattle, we have lean hogs, and the Canadian dollar and stuff. So I mean, when somebody checks this data, because this is how, you know, folks will check the COT data back in the day, you know, just looking at, you know, this aspect of the data and looking at their positions long or short. Okay. And if you look at the Swiss franc here, for example, you see the commercials, you can see they have 76,617 positions long and 30,546 position short. So the net positions here, you just take the arithmetic between 76,617 and 30,546. Okay, and that's how you find, you know, when you find the difference, you say the net long here, and this is how folks use it. But believe me, I tell you that if you look at this data like this, you're so not gonna get the real juice, because this is not what you want to really look for, because there are lots of periods, okay, the markets would be in a buy program, because this looks like a buy program for Swiss franc. Now you understand that all of these currencies traded you know, on the spot is weighted versus the dollar index. Okay, all of these currencies here is weighted versus dollar index. So when you're looking at Swiss franc, you're literally looking at USD CHF. Okay, because all of this is traded versus the dollar index on the spot market. So this is how, you know, folks used to check, or we used to check the COT data, and this is not how I want to teach it. Okay, so let's hop on to backchat.com, because I want to go straight to business really, and really stop the history. But I just want to show you that there's actual website where you can go and check for COT data, and, you know, all of those stuff, just for the benefit of knowledge, and for the benefit of those that, you know, might just be, you know, there are a lot of interesting and very curious and inquisitive folks. You know, they just want to know some stuff outside, you know, the core lesson. So we're going to go straight here. We're going to go to currencies, US dollar index, and they're giving us several contracts for dollar index. And now you see currently we're still going to use March contract. You can see we're basically using the contract that has the highest open interest. Now, what was the meaning of open interest? Well, basically, open interest just shows the outstanding position held by traders. That's what open interest is. So open interest defines, you know, where money is, or where money is coming, you know, or how money is entering the market. Because if open interest defines the outstanding position held by traders, or outstanding contract held by traders, because this is a futures market. Okay, it defines the outstanding contract, and to make a single contract makes both a buyer and a seller makes is one contract. Okay, so we're just looking for, you know, the contract with the highest volume and open interest, and that's March DXH25. Okay, DX is the symbol, H is the delivery month because March is denoted by H, June is denoted by M, September is denoted by U, and December is denoted by Z. Okay, so that's DX dollar index March 2025. So we want to pick the March contract, interactive chart, and this is a daily chart. And if you go through barchart.com, you're likely not going to find yours like this. It's because I've really used it before and I've done my settings here and there. So you can click here, the candlestick, set it to open to close, and here we have it at 6 months. So the next thing is you go to indicators and you type company of traders chart, and you can see the COT data here. Okay, the indicator would show you the commercial in red, the large spec, that's deep pocket individuals, institutions and stuff, in green, and the folks that don't matter at all, that's a small spec. This set of people that really don't know what they're doing. Okay, and so we're going to apply. So when we apply the COT data, we can put it on a 1 year basis. Okay, so we have a 1 year range, data range. All right, so you'd see the red is the commercials, the green is the large spec, and what colors is the purple, the indigo, the violet? I don't know, not good with colors really. I mean, this a friend of mine, a woman anyways, been showing me different colors and it's just weird. I don't know who came up with all of those names. Turquoise green, turquoise blue, teal green. They're really almost the same things. Just one is a darker shade of the other. So you notice something that the positions of the green is always opposing that of the red. Okay, whenever the green is down, the red is up, because generally the green are trend followers. And this COT that you look at it here, there's a midpoint, the net zero line, and the net positive and the negative line. So above the net zero line, they are long, below the net zero line, they're short. So whenever the commercials, because they are the focus, okay, you are the focus on the COT data, whenever they are below the net zero line, the markets are in a sell program. Sorry, the markets are in a buy program. What am I saying? The markets are in a sell program because it's net is negative. I do the aging program is messing in my head. All right, don't worry, you can't see the hedging program here. So whenever they're below the net zero, that's whenever they are in the negative region, they are net short, and whenever markets are above, they are net long. And you also notice that the green line is also opposing of the red line, because the green line basically the large spec, they are trend followers. Okay, they are trend followers. So you can see above the green line, you see the large specs are bullish, and you can see the markets being bullish and stuff. But the truth is, at key bottoms in the market, okay, they are usually wrong, and the commercials are usually defining the bottoms in the market. Okay, for example, you can look here, they're in a sell program and the market was selling off. All right, but as soon as there's a change in trend, you can see these folks literally, although you can see if you open this clearly, let me zoom in on this. I think, yeah, you can see they're net long here, and the green they're opposing. Okay, they're net long a little bit, can you see it? And they're defining the bottom in the market. Okay, so they define the tops and bottoms. They're usually defining tops. That's the commercials usually defining tops and bottoms. And this is how, like I said, when we went to CFTC, just looking at net long, net short, and you're thinking, okay, so I think this is it, because here again the markets are bearish, markets are in a sell program, and that's what you're going to call it. The markets are in a sell program. But the truth is, sometimes when even the markets are in sell programs, you can see prices being bullish. And how do you understand that? Because while we talk about sell program and we talk about buy program, there is also the hedging program. Because even when the markets are in a sell program, commercials do hedging here and there. Because unlike retail, when I was talking about my Twitter account, that retail, edge edge their outcomes in quotes by engaging multiple opportunities. Okay, how these guys do, because they've got a lot of money in a sell program, they can be buying. So you can, when we look at COT data through the lenses of the hedging program, you can see what smart money are doing within a buy or within a sell program. But mind you, when the hedging program is bearish, that means when the hedging program is, the signal the hedging program is giving is to sell, and the COT data on a 1 year basis is also bearish, that's high probability. Okay, it's high probability because they are in a sell program and the hedging program is also bearish. And likewise, when the COT data on a 1 year basis is bullish and the hedging program is also bullish, that's high probability. Okay, so we're gonna run we're gonna remove plot because honestly I don't know how to run the edit. I don't know how to do that. So let's make it 6 months indicators. So now we'll take out the small specs because they don't matter, and the large specs, and leave only the commercials here. And we are looking at it in the range of 6 months. Okay, because if you want to look at the hedging program, you want to study the commercials within the 6 months range. Okay, and one of the reasons why because I always talk about it, one of the reasons why I always favor looking at the COT data, because this is a much more practical way to look at institutional order flow. While there are lots of other economic data and economic reports and stuff, COT data really shows you the actions of smart money, literally. Okay, because you as a retail trader, how many of those reports do you really want to go through? You want to go through the inflation report, the employment number report, jobs, FOMC report, interpreting and seeing how it affects the market on the near term. How are you going to come up with a decision? And there's a saying in Wall Street, like you don't follow what they say, you follow the actions. And basically these folks here are defining, they define institutional order flow because they are the one with deep pockets, billions and billions of dollars. Okay, and they define, you know, how the markets are going to go and where the market is going to go based off of those economic and policies and stuff. Okay, so for us, what we just simply do is just look at the numbers and see what you're doing and join in that order flow, because it's in this that everything gets priced into the candlesticks and we begin to see reflect. So you see here, since October last, okay, since December last year, the markets were in sell program, because this is a zero line. You can see the zero line here. You can see the zero, net zero. So the markets were bullish throughout September. All the markets were in a buy program throughout, September, October, November, and mid-December, the markets dropped into, below the net zero line, and that's a sell program. But of course, even in periods here, we're still calling, bullish dollar index, because like I said, in a sell program, that's when markets are traditionally below the net zero line. When the hedging program also becomes bearish, that's high probability. Okay, that's high probability because the markets don't jump into bearish or in a sell program when it's below the net zero line and then you go in looking for sells. No, the hedging program defines real-time institutional buying and selling. So how do we now plot in the hedging program? First of all, you want to annotate the extremes of this 6-month range. Okay, you want to annotate the extremes of the 6-month range. We'll run our settings real quick. Okay, let's have this color here. That's the highest high in the 6-month range, and we're going to mark out the lowest low in 6-month range. Okay, so you see we have the highest possible net longs in the past 6 months because this is a 6-month data. Okay, and for the next shot, okay, the lowest in position here, and we're gonna put it into different vertical lines. Okay, then when we do that, the next thing is we want to define the midpoint. Now you can always blend the COT data with other tools like the open interest. You can blend it in and stuff, but I think on its own is a very useful tool. Now mind you, I only specifically use the COT data for the dollar index because I've tried using with other like the other asset like the pound, Euro USD and stuff, but I find it that it lags so much. Okay, it lags so much when I look at it from Euro USD or pound. It lags, but pairs where dollar index is like the base, like USD JPY, USD CAD, the Swissy, you're pretty much more accurate or real time. They're very sensitive in real time compared to Euro USD and the pound. Okay, so but first, I would just advise that you don't go through another rabbit hole trying to discover something, or try to add something, because you're just gonna take a whole lot of time. Okay, you're just gonna waste a whole lot of time trying to figure out something new about this stuff. So now, basically, I didn't do anything fancy. Here. All I did was, define the extreme, the highest high here and the lowest low here, and define the new midpoint. Now this midpoint becomes our new net zero line. Do you remember the original net zero line that we see? And whenever markets are below the net zero line, markets are in sell program, and when markets are above the net zero line, markets is in a buy program. Do you remember? Now when we look at it from the lens of the 6-month data, we want to mark out the extremes and define the midpoint. I used a fib retracement tool to define the midpoint. Having defined that midpoint, okay, I'm having two ranges, one above and one below. Okay, And what this says is that when markets are above our new midpoint, okay, not net zero, our new midpoint, the markets are in a buy program. And when the markets are below our midpoint, the markets are in a sell program. Now, this is the COT hedging program. And you want to look at the markets here and in September here, when markets already went bullish. You can see, and when markets stayed bullish, you can see we were literally bullish. And in December, markets already went bearish. And it only took until January for the market to top. Okay, you can see this high here, you can see this high here, and you can see this high here. But I promise you, what confirms, the COT data is market structure. Okay, this is where market structure comes in, because a market structure shift in line with the COT data confirms that shift in trend. I want you to note it. So this is how you can define the high time from institutional order flow. You can know what the high time from institutional order flow is, and then all you need to do is begin to look at market structure, things in market structure that can validate the high time frame institutional order flow. And of course, you're going to blend in some other things before you can, validate if the data is obviously kicked in. Now let's go to our chart. Now that we can now plot in the COT data. You can see it when we are above the midpoint, the markets are bullish. When we are below the midpoint, institutional order flow is bearish. This is the hedging program. So you're seeing real-time buying and selling in the markets, or real-time institutional hedging in the markets, unlike the generic net long and net short, because the markets could be net long for 2 years, but the hedging program can tell you within the net long, within those periods, there's certain period when they're hedging for short, and there are certain periods within that time frame, and they're actually buying, they're hedging for longs too. Okay, because when they're in a buy program, it means they are increasing their net long positions. That's what buy program means. And what sell program means is that they are increasing their net short positions. Okay, but the hedging program defines what they are doing at the specific time period. Okay, so we're going to go to the chart. We're going to go to trading view, and I'm going to show you something, because you really don't necessarily need to use those tools, but it's for the benefit of learning. Okay, because a beautiful chart technician made a tool, and you can see it is ICT commitment of traders by 2 degrees. Okay, when you click it, mind you, we use the COT data on the daily chart. Okay, we want to look at it on the daily chart, and he made the same tool, and this tool literally, okay, is giving you the hedging program. Okay, let's compare. You can see it. So this guy, a genius, credit to 2 degrees. I mean, I really don't have to go to batchart.com and plot the extremes, but I want to show you how we used to do it back in the day. I think I just learned about this tool. This is 2020. Whoa, in 2023. That's when an old friend, or someone I used to know, okay, because I don't class him as a friend anymore. So that's when the person showed me about this indicator, and I didn't have to go through barchart.com. So you can see periods when I'm sure you already have the indicator name saved up. If you don't, you just rewind, and you just forget name. You can see when markets were bullish, you can see bullish. Markets bearish, you can see now we're seeing markets being bearish. So you can see how stressful this consolidation was. So this is the high time frame institutional order flow. This is how we define the long-term trend in the market. And in subsequent lessons, we are going to amplify on this teaching. Okay, this is basically COT data. We're going to teach about market structure. We're going to teach key levels, and we're going to blend in how these things, how they interact. Okay, but remember, I said something. When the COT data shifts, okay, you want to wait for market structure, basically, or you want to wait for market structure. I can only, once I say or, I want to make a supplementary commentary on that, but I think instead we'll do everything. We're going to do everything in, I think, the third module, because this mentorship is a 6-part series. Okay, it's a 6-part series. Did I say 6 parts? 10 parts. I was watching Naruto Pain before I went to bed, so this whole 6 parts is in my head. Sorry, it's a 10-part series. So I think the third module we're going to return back here, but this is just like an introductory lecture and showing you how to define the high time frame institutional order flow. So you see if the COT data, once it aligns with market structure, isn't that a recipe for an ideal swing trading model? Think about it. So I hope you found this one insightful. I'll see you in the next.